Hey everybody, I hope everyone is doing well and had a good day today. In this video, I'm going to review the Emini 5-minute chart for Tuesday, October 28th, and I'm also going to talk about some price action theory. I'm going to try to keep it short today, so rather than go bar by bar, I'll just look at the chart as a whole like this, maybe scroll back for a couple of examples, but for the most part, I want to keep it concise. The first thing I want to mention as we go into the day is that there's a fairly big gap up going into the day. So if you look at the regular trading hours chart, RTH, that's RTH for short, you'll see price moved a big distance from the close of the prior day to the open of the current day. And a gap is just a space between two prices, and it functions the same way as a breakout. So a breakout, you can imagine that the gap up is simply one big bull breakout bar. So just like bar 81, except maybe 3 or 4 times the size. It opens here, it closes here, price moves a big distance in a short amount of time. If we think about, this gets into fundamental beliefs and really theory. This is what I'm about to talk about is something I cannot prove, but it's something that I assume to be the truth. And you really have to inspect the beliefs that you hold about pretty much everything as a trader in the trading universe. You know, this is something that you ought to do, or I should say, this is something that I've found to be really beneficial in my own life to do this, not only with trading universe beliefs, but beliefs about life in general. And this is something I found from one of Ali's PTM, Pro Trader mentoring sessions on the second or third watch through, must be the third watch through. He's talking about beliefs. And this is the August 2024 session. It's a reset. So it's right in I think it's in the first video. Ali gets into beliefs, and this is something that I want to touch on. For example, as we relate it to today, and we talk about price action breakouts. So my focus as a price action trader is to trade breakouts and to really understand market behavior as it relates to breakouts. So I mentioned the gap up going into the day. You can assume that the market behavior will be the same as if it's just a big breakout. But what does that even mean? Well, this gets into the theory, like I was going to say earlier. This is something I cannot prove, but I assume to be the truth. And that is that on every second of every bar, there is an institutional trader buying and an institutional trader selling. And I assume that to be true every second of every day. And the reason that fundamental belief is so important is because of the theory of trapped traders. You have traders who bought the close bar 81, sold the close of bar 81, and did not do either. They did not buy or sell on the close of 81. So there are two groups of trapped traders. Obviously, the bulls who bought made money, but the bears who sold the close of 81, they're holding a losing position on the open. The traders who did not buy are also trapped. They're trapped out of a winning trade. So the bears are trapped into a losing trade, and the traders who did not buy are trapped out of a winning trade. Both groups of traders are waiting for a pullback so that they can buy and capture a second leg. Trapped traders want to minimize or avoid a loss, and the traders who did not trade want to capture at least part of a second leg for a profitable position. So structurally, going into the day, the end of yesterday became fairly climactic. You had a 4-bar rally here, 74, getting more climactic, breaking out of a small channel line here. Bad follow through 75, bigger breakout 76, 77, sideways, so bad follow through 78 through 81, and then an even bigger bull breakout. That's 3 consecutive and growing consecutively by climaxes. So is this going to be the start of a strong bull trend, or is it possible that this is a buy vacuum testing resistance and more likely the start of a trading range, or in other words, an exhaustion gap? Well, bad follow through on bar 1, and we'll get more into it here. Also, bar 1 very far above the moving average, so context does not support a bull trend. It's a breakout of a bull channel. Even on the higher time frame, bigger picture, you can draw a channel line here, and market's breaking far above it. So pullback likely. Market is far above the moving average. Traders are forced, the bulls are forced to pay far above the average price. So the only way that a bull is willing to pay far above average is if there's far above average bullishness, or in other words, strong momentum. This is not strong momentum for the bulls, so we probably have to go lower to find traders willing to buy. I'm going to mark yesterday's high. This is one breakout point that might act as support. There's also the bottom of this tight trading range that might act as support. And also the midpoint. I'm not going to draw all the lines, but even the midpoint. This tight trading range at the end of yesterday is an area of agreement. Bulls and bears both in agreement that the price is fair. Here, market goes sideways. And then all of a sudden, there's a big bull breakout. So what's going to happen? This is a test magnet. The market's probably going to test lower, but because of the trapped traders below, a second leg up is likely. But bars 1 and 2 strong enough for its own second leg down, so bulls will probably not buy the first reversal up. 5-bar micro channel, finally a pullback, maybe a 50% pullback, but very strong bear breakout. The problem is that it's going straight into support, the moving average and the tight trading range. So a bounce was likely, but a second leg down is still likely. This was the first bull breakout attempt. Now the bulls will wait for a second reversal and a stop order setup. In the meantime, the bears are looking for a second leg down. So the bears will assume any reversal attempt will be minor. They're expecting a second leg down. The problem is that it is counter to the market regime. These big bull climaxes are probably going to get second legs of their own. I said a trading range is likely, which means I don't think an opposite trend, a bear trend, is all that likely after this much buying. It's possible we get a climactic reversal and a major trend reversal into a bear trend, but more likely the market is going to evolve into a trading range. And after a sell-off, we'll probably get a sell-off this strong, we'll probably get a second leg down, but after 2 or 3 legs, I would expect that it's more likely the market reverses and tests the highs. Remember, it's only about a 20% chance that any given day has bar 1 remain the high or the low of the day. So right now, the high of bar 1 is also a magnet. Low 1 short after the trendline break. This is strong enough for its own minor second leg. So maybe we get a bull channel, which bull channel, same thing as a bear flag. We have a bear breakout, we expect a pullback and a second leg. So the bulls are getting their trendline break strong enough for a second leg, but not enough, probably not enough to reverse this breakout before there's a test of the lows. So we need a major trend reversal. We have a trendline break, but the buying pressure really not all that strong compared to the selling pressure here. So the bulls have to do more. The bulls are doing a good job keeping all of the bars above the moving average. So this might simply be a bear leg in a trading range or in a more broad bull channel, and closing below and completely below the moving average. If the bears were really in control, then there would be bars actually crossing below and completely below the moving average. But because we stopped right at the moving average and bounced like this, it makes me wonder if it's big up, big down, big confusion. Now we're testing support in a trading range. Also, the sell climax on the open, you can count the legs from bar 2, range expansion. So trading range bar on 1, bear breakout on 2, pause on 3, another expansion on 4, and a pullback, same bar, breakout, pullback, and then another leg down on 5. So that's 1, 2, 3 pushes down to support. Like I said, the buy climax on the open might be a vacuum test of resistance. This sell-off down to bar 5 might be a vacuum test of support. I still think the bears will get a second leg, a test of the lows, but the more the bulls break this trend line, and the more bull bars we accumulate through here, the more likely bears will be disappointed on the retest, the more likely we'll find support at and below bar 4. Buyers probably come in here, and we evolve into a big trading range. So I want to speed it up. I said I don't want to take bar style. The moving average, the bounce, the second and third leg attempt, tight trading range through here. Ultimately, this bull channel was a bear flag. We had a bear breakout, pullback, complex pullback, at least 2 legs, tight trading range here, and then a second leg down to a new low. And pretty symmetrical second leg. If we measure from the high of 1 to the low close of bar 5 to the deepest part of the pullback, that's here. Not quite a leg 1 equals leg 2. If you just measure bodies, it's a lot closer. The point is, this is a symmetrical or close to symmetrical second leg of this. So the point with that, do I think bar 8 is the second leg? Is it bear breakout, leg 1, spike break, pullback, leg 2 down to the low of 8? It's possible that that's all the bears get for a second leg, but usually a breakout this big gets a second leg that consists of at least as many bars and close to the same distance. So through here, also remember that trends get weaker as they progress. So the breakout phase is the strongest part of the trend, and this one lasted 5 bars. A second leg may be in the form of a weaker trend, which is called a channel, and that may last 20 bars or so. And if we look here, maybe you say the second leg began on bar 6 because this was a lower high, bar 14, or you say the second leg began 14, or maybe you say it even started on 20. But either way, it's close to 10 to 15 bars, and it's big enough that it's the second leg for this breakout on the open. So now we have a couple of legs down, and if we now think about day structure, this is why you'll hear Al and Ali and Brad, they'll suggest that a trader waits for at least the first 6 bars, if not the first hour, before they start trading, because so much information is given the more bars you add to the chart, and that reveals information about day structure. And I've talked a little bit about how I think it's beneficial if everyone would do even a simple and I've talked about how or a trading range day, or is it a trending trading range day, and you can be creative and come up with your own classifications, build basically your own encyclopedia, because then you can refer back to these charts and compare them to the current day and ask yourself, what kind of day is likely for today? When you see the first 5 bars of today, you can automatically say, it's very unlikely that we're going to get a bull trend day. Is it possible to get a bull trend day? Of course, everything or anything is possible. You will find a bull trend day that began with a 5-bar sell-off on the open. But the point is, as a trader, if you're trading based on math, you're trading probabilities, it's unlikely that today becomes a strong bull trend day. Even if there's a rally during the day, it'll probably be some kind of trending trading range day. So automatically, by bar 5, a bull trend day is unlikely. Maybe it will be a bear trend day, but I mentioned earlier as well that it's probably not a bear trend day in this context, and that leaves a trading range day with maybe a bearish bias based on the open. Here we are at bar, let's say 26. Bears have a second leg down, strong reversal bar after attempting to break out to a new low of the day. Now, is a bear trend day likely? No, it's not very likely. There's a lot of trading range behavior through here, and the context on the higher time frame is more bullish. But a bear will make the argument, maybe bear breakout, lower highs, and it's a bear channel. We're going to test the channel line and get maybe another leg down or two. The bull sees the opposite. The bull sees the gap up, big down, trading range day likely, and reversal after 2 legs in the same direction at support. So the bears, where is the strong bear breakout below this tight trading range? I said the bottom of the trading range will act as support. Here's the breakout attempt, and here's the follow-through bar. The bears did not get follow-through. Bar 25 is a breakout bar, but the distance is very small, hardly breaking below the support. And then the follow-through is terrible. It's a very strong bull reversal bar. This is the strongest type of bar that the bulls can get, trapping bears into selling and then reversing strongly. So imagine this goes back to breakouts. Remember that a reversal is also a breakout. They function the same way. It's all about trapped traders. The bear who sold the close of bar 25 or below 25, they got trapped into selling too low. We don't know that for sure at this point in the day. This is obviously talking at the end of the day. We know the outcome. But that's ultimately what happened. The bear, maybe they see momentum, 5-bar micro channel, 6 bars without any pullback. But there are subtle hints here that can warn a trader to maybe not sell here. If you are looking to sell a pullback, or maybe even be looking to buy. And that has to do with several factors. That has to do with, like I said, day structure, the fact that today is more likely some kind of a trading range day than a bear trend day. The fact that the market is testing support, and if you look at the approach of the breakout, you've got a bear breakout 21, a pause, another breakout 23, another pause, and a third breakout 25 to that support level. I'm sure through here you can also draw 3 lines or late leg. There are several reasons or several factors against the bear breakout here. And also the fact that breakout as it grows, and say there's no spike break, your stop is in theory above 22. The risk is very big. Your stop is far, and you're asking for a big distance for 1-to-1, and it's low probability. And if you're selling far below the moving average, you need above average bearishness, which 26 is not. So it's hard for the bears to justify holding on to shorts here when the market's below the moving average and not doing very above average bearishness things. So a strong second reversal, 26, bear breakout, trendline break here, but also all of this is part of the trendline break. The bulls got a lot of bars, a lot of consecutive bars above the moving average. second leg down, but testing support. Remember what I said back in the beginning of the video. There's a trader buying and selling on every tick of every bar. Some unfortunate bear sold a low tick of 4 or sold a close of 5, and they got trapped on 6 and all of this rally. So a trader who sold down here, imagine you sold here, and this is your follow through. You're very disappointed. You know you're probably going to get a second leg, and what a trader is probably going to do here is sell here, not panic, because this is likely to get a second leg down. They'll scale in on the pullback, and then when the market retests their entry price, they make a profit on their scale in entry, and they break even on their original entry. And that buying from the bears contributes to the buying here. It's also bulls buying the breakout of the breakout point, the current low of the day, for betting against the bear breakout for all the reasons I said earlier. And for the bigger picture, day structure premise that this is probably a trading range day. And if that's the case, it's very unlikely that bar 1 remains the high of the day. At this point, if you buy the close or buy above 26, what's the probability we go and test the high of 1? It's probably 40%, because you get great risk reward. But structurally, the trade makes sense. The problem is that you have a 6 or 7 bar bear micro channel, and this may need a second leg of its own. So if you buy here, you don't put your stop below 26. Your stop goes at some distance below 26, because the reality is that if the market goes below 26, it's probably support, and it would be a bad idea to sell below 26. Just think about stop orders. Are you eager to sell below bar 26? If you had to take a stop order trade on 26, would you rather buy above the bar or sell below the bar? And to me, it makes more sense to look to buy above the bar. The stop order did not trigger 27 and inside bar, possibly the second leg for this bear breakout. But the micro channel continuing, bulls looking to break the bear trend line. 3 bar micro channel to bar 30. Bars uniform in size. Structure is strong for the bulls. A nested second reversal up at the bottom of a trading range. 1, 2, and here. 1, 2. So probably buy the close for the bulls. Remember the bears who sold 25, got trapped at 26. They used 27 to exit. So what happened on the bigger picture, on the larger scale, big picture here, bears who sold the low, scaled in, and exit on the retest. That happened here as well. Bears sell the close 25, betting on the breakout. They get trapped at 26. They scale in, maybe at the open of the bar or the high of the bar, maybe the 50% pullback of the bar, whatever the case may be. But 26 is disappointing enough that the bears are probably going to scalp out and not hold on to the trade for a swing. And that's why the close of 25 and the low of 25 becomes support, and then the market reverses up in this way. This is really dangerous for the bears. This type of buying, it's subtle, but there's a lot going for the bulls here that wasn't present over here. The consecutive buy climaxes, or here, the bars that are expanding and contracting. These are really uniform in size, and this is strong control over price and time. The bulls are controlling 3 consecutive bars. The bars are uniform in size, so they're very similar in size, and price is moving consistently higher and higher. There is no micro gap, and the market is approaching resistance, the moving average, so it's possible we pull back here, but it is likely that 28 through 30 gets a second leg, and then we get the bull breakout 31, trapped traders at the moving average. Moving average becomes support, and higher prices are likely. I said I wasn't going to do bar by bar, so I really need to speed it up here. 36, 37, a buy climax, so this micro channel continued for another couple of bars, a little climactic on 32, leading to a small 2 or 3-legged pullback. This is minor. On a smaller time frame, it's 2 or 3 legs. Bear, reversal, pause, or pullback, second leg, but testing support. Remember I said when the market crossed the moving average, look at the low of bar 31, no tail. So the high of 30, the moving average, maybe the close of 30, that price becomes support. Traders selling the moving average got trapped. Market comes back close to their entry price, and then bulls and bears are buying again. The trapped bears exiting their losing position, and the bulls are buying because there's strong momentum and the structure is strong. This might be leg 1 at the bottom of a trading range after 2 legs down. 36-37, huge climactic bull breakout, second leg to a new high. Probably trading range behavior to follow after such is 36-37, a second leg trap. Trading breakouts in second legs and you're looking to sell. Where is the bear breakout that you're looking to capture the second leg of? Is it the tail, the implied bear breakout on 37? And is that enough to really sell the close 37? So for me, this is an area to probably wait. 36-37 clearly trapped traders below. There's several breakout points, maybe a best fit horizontal line somewhere around here. Trapping traders, 37 trapping traders who sold here or for any reason, which creates support in this area. You can see 38 testing it and the reaction on 39 leading to higher prices. Tight bull channel, first reversal will probably be minor, so even though it's 3 legs up to 43, this is not enough to reverse the bull breakout. So all of this is a breakout on a higher time frame. If you look at a higher time frame chart, you would not see the pullbacks along the way. This would simply be a couple of consecutive bull trend bars. So this is not enough to reverse the trend. The bulls are likely to get a second leg up, so higher prices likely. This is more likely a minor reversal. And higher prices we got in the form of a 2-legged climactic breakout on 58. 58, if you count all the legs, maybe it's 1, 2, 3, 4, maybe even 5. So 58, clearly a late leg, and clearly one of the biggest bars on the chart, certainly the biggest bar since 39, and late in a trend. So is 58 a measuring gap that's going to lead to more bull trend? It goes back to day structure. We said after a big sell-off on the open like that and all this trading range price action, a bull trend day is not likely. It's possible, but it's not likely. Also, late leg, you're 30 bars into a trend, so this is more likely going to be an exhaustive buy climax that traps bulls into buying too high, only to reverse. Doesn't necessarily mean it'll reverse into a bear trend, but a trading range is more likely to follow, or a trading range or a bear trend is more likely to follow than more of a bull trend. Bad follow through, 3 consecutive bear bars. Probably sell the close, sell a pullback. Traders who bought 58 know they're trapped and they're desperate for a pullback to get out. They're getting the pullback, 66, a 2-legged pullback, testing the breakout point. 59 low. You've also got the close of 58, resistance. So small reaction there. Finally testing the high close of 58 on 71. But you know, on a smaller time frame, 63 through 71 is a bull channel. And remember what I said about bull channels back here. Bear breakout, bull channel, bear flag, second leg down. Bear breakout, bull channel is a bear flag, you may get a second leg down. If you count legs, you've already got 3 or 4 legs up, even if you only count spike breaks. Leg 1, pull back, leg 2, pull back, leg 3, 3 legs to resistance. So wedge double top after a possible, or I should say a probable, exhaustive buy climax where a trading range is more likely to follow. 3 legs up to a double top. Probably not wise to buy 71. Better to look to sell in this area. 72, the bull breakout, trapping traders who bought, but traders will sell and scale in, which makes 73 in this area support. So maybe you get a second leg up, but instead we've broke far below this expected resistance of 58, and it's evolving into a trading range. 74, obviously, strong enough bear breakout to trap traders above, so second leg down likely. And the bears got immediate follow through. So micro channel down to basically the end of the day, bar 80. Alright, that's going to be it for today's end of day review. Thanks everybody for watching, and I hope everyone has a great night.